If there's a double bottom on the charts and the market breaks that double bottom through to the downside and then it starts retracing up, is that a fake out? Is that a liquidity grab of these bottoms and then the market is going to reverse through to the upside? Or is it a trend continuation where the market breaks the double bottom, comes back up, retests a certain area, and then continues going down? How do you determine the difference? Because obviously by determining the difference, you can trade it more accurately and increase your win rate. Now, this is exactly what happened on oil this week. On the 1 hour chart, you can go ahead and find it. There was a double bottom, and then the market went below this double bottom and then started retracing up. Now, everyone was looking at this retracement up and saying, is that a liquidity grab? Is that a fake out? Is oil about to reverse through to the upside after liquidating these bottoms? And then I can trade it through to the upside? Or is that a trend continuation down where the market breaks this double bottom, goes back up, retests, let's say, a certain support line or a certain trend line or whatever it might be, and then continue going through to the downside? Is it a liquidity grab or is it not? And the way people were trying to determine the answer is by trying to evaluate the candlesticks that are being printed. So they're like, yeah, so it went below the double bottoms with volume, so it must mean that it's a trend continuation because it looks like there's a lot of sellers, and that's why there's big red candlesticks, right, breaking these bottoms through to the downside. So it might be a trend continuation through to the downside. And therefore, you're trying to determine whether it's a liquidity grab, whether it's a fake out, or whether it's a simple break and retest through to the downside and the market is going to continue down by trying to assess the candlesticks that are being presented. Technical analysis. Now, what I find to be a lot more accurate in those situations is to assess the fundamental aspect of the chart, which would make the answer a lot easier and a lot more accurate. There is a war ongoing right now. Iran is being bombed. The Strait of Hormuz is closed. Oil facilities in the Gulf have been bombed. As a result of that, oil prices are supposed to go up during these circumstances. So as a result of that, when we look at this double bottom being broken through to the downside and then the market is retracing through to the upside, that's obviously a liquidity grab because oil needs to be bullish in those circumstances. So I don't look at the candlesticks and try to evaluate the way these candlesticks are being created to determine whether it's a liquidity grab or whether it's a market continuation through to the downside. I don't do that. I analyze the fundamental aspect of the charts. Since the fundamental aspect is bullish, then the market breaking below these bottoms and then retracing up is obviously a fake out, and the market is going to continue pushing through to the upside. By evaluating the fundamental aspect of the charts, you will be capable of determining whether the break of certain lows is a liquidity grab or market continuation a lot easier and a lot more accurately.